Mets owners have reached a settlement in the Madoff case. I'm Winnie O'Kelly, reporting for Business Day Live. I'll be speaking shortly with Evelyn Rusley about Apple's plans for its pile of cash. We've also got Larry Kantor, the head of research at Barclays Capital. And Brooks Barnes will take us inside the marketing strategy of what Hollywood thinks may be the next blockbuster. But first, we've an update from the Madoff case. Joining me now is Peter Latman from DealBook. Hello, Peter.
Hey, Winnie.
So, the Wilpons, the owners of the Mets, have been battling with the trustee in the Madoff case over giving some of the money back that had come out of the Madoff investments, and they were set to go to trial. What's happened this morning?
So it's pretty dramatic news, and at the same time anticlimactic news, because they were supposed to go to trial this morning, and they literally settled on the courthouse steps. The two sides have agreed to a settlement, and what's going to happen is the Mets owners, the Wilpons and the Katzes, are going to pay the Madoff trustee $162 million, which is right down the middle of the amount that they could have paid, which was as much as $350 million, and on the low end, they were already on the hook for about $80 million.
So what was the incentive for the trustee, Picard, to do this instead of going to trial?
Well, it was a complicated case, and look, in some ways there's no ties in baseball, but I think the way to characterize this is it's sort of a tie. They've been battling for the last year, as you've said, accusing the Wilpons of being willfully blind to all the red flags that the Madoff fraud had, essentially being complicit in the fraud. But it was a real risk to bring this case to trial, because if they got a negative ruling and didn't prove their case, it could have hurt all of their other cases that they have against much bigger fish, like the banks, like JP Morgan. Right. So if they got a negative ruling, it could have hurt. So
in a sense, this is better for them because it doesn't risk as much some of the other cases that were out there. They don't have to worry about a bad precedent.
That's right. And look, this would have been the first case that would have gone to trial. It was unclear how a jury would have ruled. And on the other side, the Mets really didn't want 2 more weeks of bad publicity, right? This has been an ugly battle, and the trial would have been, daily coverage with big headlines. And after all, they've got spring training down in Florida, so they've got other things on their minds.
So what does this mean for the financially strapped Mets? They were already struggling. Where are they going to get the money?
Well, they say that the money is going to come from the fact that they were net losers in the Madoff scheme, meaning they put more money in than they got out. So they can get that money hopefully in a recovery from the trustee and use it to pay the settlement, and it hopefully won't affect the Mets' finances. That said, as we know, the Mets' financials are already somewhat strapped, and this certainly isn't great news for the team.
Wow. Thanks so much for joining us today, Peter.
Thanks, Winnie.
Now let's get back to Apple. The company announced this morning it would initiate a regular dividend on its stock, as well as a share buyback. Joining me to talk about this is reporter Evelyn Rusley.
Good morning.
Good morning. So, under Steve Jobs, Apple was sitting under, what, $100 billion in cash, and yet had resisted this. What's changed here?
Well, that's right. As of December, they had nearly $100 billion, and there was mounting pressure from Wall Street for them to do something because they were earning so little interest on that cash. But eventually they just capitulated to investors and the idea, well, we have to put some of this money to work. So they issued a $2.65 dividend that'll be coming down later this year.
And that's paid quarterly to investors.
Yes, yes. And on top of that, they will have a $10 billion share buyback program. In total, those two announcements will equal about $45 billion over the next 3 years. So it is quite a large sum of money, but at the same time, Apple is still generating a lot of cash. They added more than $30 billion last year in cash. And as they say, their iPad sales are very robust, as well as iPhone, Mac. So analysts on Wall Street expect them to just generate more and more cash over the next few years.
So where did we go from here? When Microsoft, for example, started paying a dividend, people said it's a mature company. It's no longer a big growth company. Should we have those kind of concerns about Apple?
I don't think analysts are saying the exact same thing with Apple here. I think that when you look at the sales growth of all those products and how they continue to make such high margins, the expectation is that Apple is actually quite a fast-growing company, though it may be considered mature when you consider how many years it's been around the block. So I think for Apple, they're just going to continue to manage investors' interest. And they said on the call today that they did this also to attract new investors, because some some were saying, you know, we can't justify having Apple on our books when it's not issuing a dividend and the stock has run up so significantly.
Well, finally, this won't take care of anywhere near all of their cash. They have a lot of cash in the U.S., but a lot more cash abroad. What did they say about that?
Yeah, what's significant about these announcements is that they're drawing from their domestic cash pile. And Cook and the executives said that Apple is not drawing from their international cash pile because of all the taxes that would involve. So they're hoping that Washington will eventually change the laws and allow them to repatriate some of this cash back from abroad. But in the meantime, what they said is we're going to use our domestic cash pile and we'll still have enough to do some strategic options, maybe some acquisitions as they have in the past.
Thanks so much for joining us today, Evelyn.
Thank you.
Now we've got Larry Kantor on the line. He's the head of research at Barclays Capital. Good morning, Larry.
How are you?
Good. So let's talk about investors in dividend stocks. Investors looking for yield have really been struggling of late. Does the new dividend by Apple tell us something about what companies are going to be doing in the future?
I'd say no. I think Apple is a special case. I mean, it's true. You know, we're now a few years away from the recession. The banks obviously are better capitalized. They're starting. We saw J.P. Morgan last week announce a dividend. So that's part of a trend. I think Apple's in a somewhat unique position, having had a lot of cash on its balance sheet for many years and not delivering a dividend. And after a lot of clamoring from investors, finally delivering one. And I think also it will appeal to a different class of investors who do look at stocks that pay dividends. So that's helpful. On the other side of the coin, though, is the question of whether this signals that they're not going to be reinvesting it as much in new products, or that they don't have as many new products on the, you know, in the future. So I think it's a balanced thing. So I think net, it's probably not going to do very much to the stock.
So tech stocks have been really on a roar here. Apple was one of many. You know, can we look ahead to the broader market? Now that we sort of have the European debt crisis at least subdued for the moment, if not taken care of, what's sort of your outlook for the rest of the year?
Yeah, I mean, we think this rally has some legs. I mean, for the last 6 to 9 months, the two issues that have really weighed on the market is one, concerns about global growth and the possibility of a double-dip recession, and the second is the European debt crisis. And both of them look a lot better today than they did 3 months ago. So in our view, this rally is justified. Going forward, what it looks like to us is that there's been actually very narrow participation in this rally. You see it in very low volumes. You see it when we talk to our clients, many of which remain skeptical and have been on the sidelines. And that tells you probably there is some more legs to this thing. So we see the market continuing to rise for another month or two.
And in terms of the economy, you know, we've gotten off to maybe not as fast of a start this year as we would like coming out of such a deep downturn. What's your outlook for the rest of the year?
Yeah, I think the U.S. is on a solid but not spectacular growth track. I think before the U.S. gets to a normal recovery, you've got to see single-family housing recovering, and it's not. Multifamily has recovered, but not single-family housing, and it's unlikely to do so before the election. So that will kick in at some point, but it's not kicking in yet. So I think you're probably looking at a U.S. economy that's going to trend in the 2 to 2.5% range, but the labor market should continue to grow, and I think it's a solid recovery, but not a very fast-growing recovery.
So Bernanke, the Fed chairman, he sort of put a little damper recently in his remarks, saying that maybe the jobs had improved faster than the economy. Do you think the economy is going to pick up enough to keep that kind of job growth that we're so desperate to see?
Pretty much. I mean, it may taper off a little bit, but I think the labor market is following the economy. I think that it's true. I think what Bernanke was referring to is that GDP growth has been lower than what you'd expect given this labor market growth. Who knows, maybe they'll revise the GDP growth up. But the labor market numbers are easy to believe because they've been corroborated from so many different sources. It's not just the payroll survey, it's the household survey, it's jobless claims. You see it in the confidence surveys. The job market's clearly improved. I think going forward, the thing to watch is probably energy prices. Rather than the European debt crisis.
Right, we're shifting our attentions. Thanks so much for your outlook and speaking with me today.
Sure.
The Hunger Games is a series of wildly popular novels aimed at young adults. Now executives at film studio Lionsgate are hoping they can translate that popularity into dollars spent on movie tickets. My colleague, Brooks Barnes, takes a look inside the marketing strategy for the film.
This is the time to show them everything.
If Hollywood has its way, The Hunger Games is going to be one of the biggest movie franchises of the decade. It's based on a trilogy of books by Suzanne Collins, and the hope is that it's going to be a Twilight, a Harry Potter, a Lord of the Rings for a new generation.
Happy Hunger Games!
The marketing campaign is commensurately huge. The goal is to create some sort of world that can be immersive for fans, but this is a movie that's about children killing children. The challenge was, how do you sell a movie without showing half of the film?
And so it was decreed that each year the 12 districts of Pan Am shall offer up in tribute one young man and woman between the ages of 12 and 18 to be trained in the art of survival and to be prepared to fight to the death.
If this movie is as big of a hit as they think it's going to be, it's going to have ramifications for how Hollywood markets movies. So to find out how they dealt with this, I went to speak with Tim Palin, the president of marketing at Lionsgate.
When you do something online, you can actually gauge the reaction immediately, and you can people participate in the dissemination of that.
One way to think about how they're approaching this is to think of it as an online brush fire. If you're looking at engaging fans, you're trying to set little fires at the beginning of the campaign, fanning those flames through Twitter and Facebook, and then hopefully emerging with the box office inferno. So one component of the campaign was registering people as citizens of this futuristic world. Over 800,000 people have done that.
It's not just you buy a poster and you hang it on your wall like you did in the 80s, and you would go to a convention for Star Trek once a year and you would speak to your people there. Now you can actually do it every day.
They want people feeling invested in this movie like it's theirs. At the same time, if you're thinking about it like that forest fire, it's not just pouring gas and letting trees burn. It's done in a very methodical way. This is very much a product of a marketing department, and they have fire breaks, and it's all very contained.
We're asking them to invest in a journey that's, 4 movies long. They're passionate about the books.
As studios try to engage fans with these new online tools, who's driving popular culture? Is it the studios like they've always done? Is it the fans pushing it the other way? Or is it studios convincing fans that they're doing it when it's really a Hollywood product all along?
Online at nytimes.com for our continuing coverage of this and other stories. I'm Winnie O'Kelly, reporting for Business Day Live. Thanks for watching.